Okay, guys, thanks all for being here. So I'd like to just hear from you, who you are. So let's go in seating order, starting with Cornelia and ending with Adam. Just give us a quick introduction.
Sure, great. Thank you, Rachel. Great to be here, loving the buzz and the energy out there. It's fantastic to have everyone back in person again. My name is Cornelia Andersson. I work for the London Stock Exchange Group and head up the M&A and capital raising business under Refinitiv. So a relatively large market data business which provides services to investment banks, corporates, financial institutions across the world.
Thank you, Cornelia.
Hi, my name is Refinitiv, and I think the relevancy for the panel is my former job. So I was the founder and CEO of FXCM, and we went public as an FX broker in December 2010. So I've been through the ringer, ups and downs of doing this.
Thank you, Drew.
And Adam Kostyal, and I head up the listings for Nasdaq, covering Europe. So we own and operate the Nordic exchanges, and then of course help European companies access the US as well.
Thank you, Adam. So my first question is for all of you, and I encourage you to jump into the discussion at any time. What I'd like to know is just kind of give us an overview. What are the trends that you've observed in terms of the types and volume of companies that go public in 2021, compared to, for example, 2020, which was kind of an exceptional year, but also in the last, let's say, 3 to 5 years?
All right, why don't I kick that one off? So one of the things that we do at Refinitiv is that we publish market statistics, right? So every quarter we do a review of what's going on in the capital markets. And if we look at the IPO space in particular, so 2020 was an anomaly in the sense that we had the impact of the pandemic. M&A markets fell off a cliff and pretty much ground to a halt. But what we saw on the capital market side was quite interesting, right? So 2020 was an absolute boom for debt capital markets. And we also started to see the same on the equity side, right? But going into 2021, we are in fact in a record-breaking year. So since records began in 1980, this is the largest IPO year to date. So we raised over $360 billion globally. Which is a phenomenal amount and a big increase on last year as well. Some of this has been driven, of course, by SPAC activity, which we can talk more about. But we also see a lot of increase in IPOs from particularly tech companies, from financials, some from healthcare as well. And look, my take on this as well is that we're now in a state of new normal. So whereas last year there was some hesitancy around pursuing the IPO route, a lot of those concerns have now subsided. C-suite executives are fully on board. There's also been a lot of work from exchanges across the world in terms of improving the listings process and really facilitating that side of things. So those are my 2 cents on what we're seeing in the IPO markets at the moment.
Absolutely. Drew, Adam, what have you observed in terms of trends?
Should I start? So yeah, I echo what Cornelia is saying. This is a record year in many dimensions, I think on a global level. We own and operate the Nordic exchanges. There we've listed close to 160 companies only this year, which is fantastic. In the US, of course, we're close to 600 listings on Nasdaq. Largely driven by the SPAC activity, but that's calmed down a bit. Now we're starting to see business combinations come to market. We're listing a German company today called Sonos Motors, doing an IPO. So there's a continued interest from Europe to US because of the risk appetite we see in the US markets, which is quite, dramatically different compared to what we're seeing in Europe, unfortunately. But we continue to see a great appetite for European companies to access the US capital markets. So, but on overall, record numbers, record level of activity, probably going to continue into next year. Probably we'll see more volatility come to the market, but the appetite is still there as long as the interest rates are still relatively low.
Okay. Yes, thank you. And Drew?
I think from the audience in the room, probably the most important thing is we're 12 years into a bull market, right? 12, 11. And this is the best time to go public. Valuations are the highest, all the obvious reasons, right? And when valuations are high and bankers are making big fees, They check less. They care less. A lot of companies are gone public the last few years. When we went public in 2010, which was, right, like really only 2 years after the financial crisis, it was enormous amount of diligence, right? So there was no way the companies that went public today would have gone public in 2010, right? Don't have the earnings, they don't have, those things, and what you get is the fact that some company with no earnings can have a $100 billion market cap, it has no revenues, get a $100 billion market cap, is basically beyond insane. And the likelihood that that will repeat itself when the markets go down is unlikely. So I think from a perspective of trend, even though the FX business, because it's not volatile, isn't doing as well, from a capital markets perspective, there's no better time. There's no better time to squeeze out from that window. And if you look at like the FXEM experience, we sort of timed it wrong. So we did it on the back of 3 years of awesome financials, because 08, 09, 10 was like the most volatile, and everybody suffers except for people like us who did amazing, right? But then as soon as we went public, 6 months later, volatility ended. So that was like the worst timing ever. So from a perspective of going public, it's better to go public when the FX business is down and everything else is up. And then if the market crashes, the FX business does well. Even though initially the stock will go down, actually it will outperform in a market crash, because obviously the business will do really well. So, but a lot of FX guys think you need to wait for a bad market to prove yourself, bad equity market because it's a good FX market. It's actually, like we tried in 08, 09, and nobody would take us public despite our earnings being insane, because people were saying, no, window's closed. I think only Google or something went public in that time, right? Like it had to be that big.
Yeah, but I think you're referring to investor due diligence, I guess?
Everything,
Overall,
banker due diligence, investor due diligence, all of it.
Well, I think what you're saying at the end of the day is that there's a bigger risk appetite in this market, and that translates into bigger bets. And the question is, which bets will go home or not. I think at the end of the day, I think there's a big debate, where should that risk be? Should it be in the public markets or should it be outside the public markets? And at the end of the day, I think, it's good that it's in the public markets because a lot of these businesses need the public markets to really do what they're aiming to do. The question is if the valuations are right or not. That's debatable,
Right.
There's a lot of bets which I wouldn't have made back in the day, when companies were listing. I regret not having made them at the time. So let's see where the ball lands. But clearly, there's a lot more risk appetite in the market, and there's a huge dynamic, and we'll probably continue to see that dynamic as long as interest rates stay low. But let's see where interest rates end up, and how quickly.
Yeah, I think that's a really good point, right? We are in a bull market unlike anything we've ever seen before. And that has to change at some point. There is going to be a correction. The big question is when, and what's that correction going to look like? So valuations are high at the moment. It's a very favorable environment for raising capital. And out of the pandemic, what we're hearing from executives across the world is a renewed focus on strategy, right? It's going after the opportunities that they need to grow their business. It's divesting assets that they no longer need. And there is a continued risk appetite here, both from the issuers as well from investors.
Yeah, absolutely. So what I'm hearing from you guys is obviously there's this, it's not necessarily a lack of due diligence, but perhaps this greater risk appetite that's driving activity and making companies go public more and more frequently. And I also heard from both Cornelia and from Adam something about SPAC activity. So can you talk about that for a moment?
Yeah, I mean, it's been predominantly in the US. I think Europe is still debating whether or not SPACs should be or not be, but in the US, it's not something new. What it essentially is it's a revamped concept applied in a different perspective. And I think the SPAC boom was really at the beginning of the year. I think it's calmed down a lot. I think the incentives, if you want to call it that way, between the sponsors and the founders and the investors have to be realigned to make it really substantial and long-term. But essentially, at the end of the day, it's really opened the door to access the public markets for a private company, where they have one more option to access the public markets rather than do an IPO. At the end of the day, it's for each company to assess which route is the best for them. I think personally that the fact that you have one or two more roads or routes to come to the public market is good. The scrutiny has to be there, both from an investor point of view and from a governance point of view. I think sometimes, however, the SPAC concept and the dynamics of the SPAC concept is not fully understood by the investors. And that has a consequence long term of the sustainability of that product. So from my perspective, I think SPACs will stay here, not potentially be as dynamic as they have been, but it's still a viable option if packaged in the right way. And we listed a number of European, UK companies. Arrival is one, electric vehicle company that came to market through a SPAC in the US. One of the key drivers for them to use a SPAC is that the SPAC tends to be a bit allow you to be a bit more forward-looking in terms of your statements versus IPO. Is that good or bad? It's up to the investor to decide what they invest in. And it's up to the company to decide which route they want to take to the market.
Yeah, so let me add a few thoughts on that. And just to sort of take a step back, so the SPACs, special purpose acquisition companies, they're basically black check vehicles that are used to take a private company public, sort of in a roundabout way, avoiding the typical IPO process. So you list the SPAC on an exchange, and then that SPAC will acquire a private company, thereby making the target public. And you're absolutely right, Adam, that this was really something that we saw booming in Q1 of this year, where SPACs accounted for the majority of the IPO volumes. They continue to be quite an important influence in the market. And if we look at the corresponding M&A volumes here, which are roughly sort of $4 trillion so far this year, SPACs account for about probably 12-15% of that. So it's definitely not negligible. And even though activity is slowed down, I think we'll continue to see SPACs as an important influence here. The point around risk and transparency, I think, is really important. SPACs are basically a way for the regular investor to tap into the kind of star deal-making expertise of private equity veterans, for example, or hedge fund veterans that otherwise would only be accessible to institutional investors. So in some ways, it's an interesting way of democratizing access to some of these, the absolute best deal makers of the world, people like Bill Ackman, Chin Chu, or Blackstone, and so on. But of course, it comes with very little transparency, and there's a much higher risk profile there. So, as Adam says, it's really an investor call here in terms of your risk appetite and what you're comfortable with. I don't think we're going to see massive growth in Europe. I think it will continue in the US. Europe, I think, is on the fence, and unless there's some significant shift in regulation, I don't think we'll see a lot of SPAC activity here.
But maybe just to add one thing, I think that Europe actually needs a SPAC concept in many markets where we lack a commitment from long-term holders of a company and, to put their cards on the table in terms of showing their commitment to support that company in the public markets. And if done right, and the sponsors of the SPAC bring a company to the market, they take a commitment to make this company succeed even in the public markets, that's where the incentives need to be aligned on a more long-term basis maybe than they were in the original concept of the SPAC in the beginning. So, and the level of scrutiny is just the same as when you do an IPO for the company itself. That's why we're seeing a clear slowdown in terms of the business combinations when the companies combine with a SPAC, that they're finding out that it's just as burdensome to come to market through that route as it is to come through an IPO, potentially even more burdensome.
Yeah, we looked at a SPAC when we were thinking of going public, and It's faster, but it's more dilution, it costs more. So we were too greedy to do that. We said, no, we could sell it ourselves. But if time is of the essence, absolutely. And I think that it was a due diligence light version until the SEC said, well, it's too due diligence light. So they tightened up the reins. That's why the activity slowed down. But so now it's not as, like you're saying, it's not due diligence light anymore, but it used to be, and like the height of it. But I think that it's one of those things that I will still say, timing is everything, and it's hard to know, how it's going to be. But for our sector in particular, there is no better time. I think there is a thing that this business is looked on very suspiciously, right? It had a lot of issues, it has regulatory stuff, right? So it's not popular there. When the risk appetite is high, people tolerate a lot of stuff because investors want as many things as possible. And the comparisons you're looking at is, the FX business actually is a very positive cash flow business. It's actually a very solid business fundamental, right? Not as high growing as some of the tech stuff that's coming out, but it's actually much more solid. And if you got growth and you've got, the cash base, then obviously that's ideal. And but in a worse environment, people are going to say, if you don't have this and this and this and this, your valuation is going to be microscopically small, right? And I think that's the other thing. I think one of the things that bankers don't sell properly is, how bad is it going to be if you are a small company as a public company, right? And the crazy valuations of today allow even small companies to have a high enough market cap that it's not just small cap funds buying their stock, it's mid cap funds or even large cap funds. So it matters because the majority of those funds in the stock market actually, I know you say it, like constitutionally exist only to buy large shares, right? And that's the very, very large majority of funds that trade equities, right? So if you're a small cap stock, you're stuck with very, very few investors, relatively speaking, so your valuation is going to be much lower. So you take a period like now where, you get something where you're going to have a much higher valuation just because the market's like this. Once you move to that mid cap instead of a small cap, all of a sudden you're in a totally different world valuation-wise. You're in a totally different world, investor relations, all of those things. So I think, like I said, there is no better time today. And if you have to pay the extra fees to do it through a SPAC to do it quickly, I would still do it.
I think maybe to add to that is the appearance of the retail market, which has grown substantially during the pandemic. I think everybody's aware of that, noticed that. And of course, from a pure equity point of view, that's introduced a new dynamic, which we hadn't seen in the markets in the same way, I think on a global level. So to your point about, the lack of institutional investors on the small cap, micro cap level, well, to a large extent, the retail has stepped in and backed a lot of these companies in a way we haven't seen before, through Robinhood and eToro and many others. So from that perspective, that's a new dynamic in the market that was missing, for good and bad. But the struggle of this micro cap, small cap company is a struggle. But at the end of the day, the way I compare it is that when you are in the public markets, you have different assets to grow your company, rather than just money that you have outside in the private market, because you have the share, you can do acquisitions, you have credibility, you have transparency, you can use the debt market if your business allows it. So you have a platform of a broader range of assets to help grow and finance your business over time.
Any other comments on the sort of appearance of this new class of retail investors that we've seen since, I guess, the beginning of 2020?
Don't count on them.
What do you mean?
Right?
What do you mean?
Because when the market turns, they're gone, right? They're the first to go. They were here the last bull market. They were the first to leave. They're the last to come back. At the end of the day, you know, like bankers will come to companies and say, oh, you know, we have this huge retail distribution base, and you want retail, especially the brokers, they'll pitch the concept that if lots of retail clients buy your stock, they can also become clients because they know your name, and that's bullshit. And the reality is stock doesn't support on retail. I mean, you're right that today, you know, you get to be a meme on Twitter, then, you know, like people buy your stock in droves. But, you know, like a year from now, that may not be the case whatsoever, you know, and you are reliant very much on institutional investors who are very much slotted into very specific categories. So you want the biggest slot possible, you know, and the fact that, you know, you've got companies that are very relatively immature, getting large market caps really helps them out. And I think I agree with you that, you know, like credibility-wise, to do that now is the best thing. Because I think when we went public, within 2 years, our customer assets quintupled, right? Like just because of credibility, like instantly, you know, and so we had instant credibility. It did not hurt that the founders made a lot of money, you know, at all. That was the best thing, you know, part of that. But it was I think that you get, and we did acquisition, like we were private for 11 years before, and we never did an acquisition, right? And we did 8 after we went public because you can use shares, you can, you know, you're right, you can raise debt easily. I think we borrowed money at like 2% or something. You know, it was one of those things that was just, you can do things you couldn't do before. Because your credibility is not just there with retail investors globally, but it's there with, you know, with the institutions, bank. Everybody instantly looks at you completely different. You don't get this question like, who are you again? What do you do? Even your grandmother will recognize what you do, and that's important. And so I think that, in that sense, like, that's a big deal. Going public was a huge, huge step, right? So, and there's no substitute for it. But, you know, it just cost a lot.
Yeah, and it's a very different investor base, right? So if you think about what a lot of corporates do, is that they spend time through their investor relations department, through their management team, on building relationships with the investment communities as well as with the analysts out there, right? So the investment research analysts, to really communicate, you know, what's the story of the company, what's the long-term narrative, how are they going to achieve growth? With retail investors, that isn't really possible, right? So it tends to be a much more superficial relationship, trading in and out of the stock, and it's much more difficult to convince them of that longer-term strategy and story of your business. So it certainly comes with additional challenges.
Definitely. And speaking of greater retail involvement, I also want to ask you about the sort of, you know, not only new kinds of investors coming in through fractionalized stocks and that sort of thing on platforms like Robinhood, we've also seen sort of an uptick in different kinds of cryptocurrency raising tools. So obviously we had the ICO boom in 2017. That was kind of, you know, here and then gone. But now we're seeing STOs, IDOs, exchange raises, all these different kinds of tools. I mean, from your perspective, is that going to kind of be like ICOs? Will it be here and then gone? And if not, you know, what's next? How is this going to affect the way that companies raise?
Well, I mean, I think we are an exchange, and we're also technology providers. So we provide technology to a lot of these crypto exchanges on a global level. So we provide surveillance technology, trading technology. So we have a number of these crypto exchanges as customers. So for us, it's a fundamental shift which we're trying to support from a service provider perspective. Then you have the exchange dynamic where, you know, where you see now there's more and more future contracts appearing and listing on the exchange. So the way we see it, I think, I was in the US last week. There's a dynamic now where a lot of voters own crypto, and the governments are not prepared to back away from that now. They're going to try to regulate that. The more it regulates, the more it can appear on the exchange. And we will see a dynamic where we will see an aspect of crypto coming to market, whether it's companies, whether it's exchanges, whether it's brokerage firms. There will be a crypto offering in different ways. Replacing the traditional IPO with a crypto offering, I think is a bit more challenging if you look at it from an ICO perspective, etc. Because I think the worst thing that happened with the ICO was the lack of credibility. And I think a lot of people burnt themselves on that, and that from that perspective, it didn't replace the... At the end of the day, whichever way we can create more efficiency in the capital markets with credibility, it's encouraged and welcomed. But I think it's going to be difficult to see that a traditional IPO is going to be replaced by a crypto offering in the short term. Having said that, investing in companies or investing in the public markets will have a crypto flavor going forward, and we're seeing that now. CBOE launched their futures. We launched another future on our market the other day. You know, this is something the market is demanding, and it will be offered.
Yeah, like I very much agree with that. So, you know, there's a couple of really important points here. And while we're going to continue to see the influence of different kinds of crypto assets. So, for example, the London Stock Exchange Group recently launched various indices around digital assets. So there's absolutely money being traded on the base of this. However, I think where we're going to see more influence and more efficiency is around blockchain and around distributed ledger technology in terms of the capital issuance process, right? So if we look at what happens today, whether it's an IPO or whether it's a bond issue, it's a very old-fashioned manual process today, right? It hasn't changed for many decades. And the banks sit in the middle of this, acting as the book runners or the underwriters, so pricing the issue, distributing the shares or the bonds across the investor community. And that process is done very much offline today, right? So there are certain tools out there, but a lot of this happens in Excel, it happens over the phone. So there is absolutely room for improvement there and for efficiencies. I guess the question we need to ask ourselves is that we've had this technology for a long time. We've been talking about improving the way the capital is issued for many years. Why hasn't it changed? And I think the answer is around the business model here, right? Because this is a business model that works today. It gives companies access to the capital markets, whether it's in the US or elsewhere in the world. It also puts the banks very firmly in the center of this process. And it's a stable, lucrative business model. So I think that unless we get buy-in from really the big investment banks here, the pace of change is going to slow down. But having said that, right, this is starting to happen. So I don't know if you saw that Goldman invested in the Capital Markets Gateway startup. I think it's Chicago-based or Seattle-based, which is a platform around raising capital digitally. So there's certainly steps being taken towards this. But I think, well, it's sort of in the mainstream space, pace of change is probably slower than what we would have expected.
Yeah, I would say the banks are semi-slow. The mutual fund companies, like the big investment firms, are molasses in comparison. And so they will change the slowest. And I think that they care more about, you know, people who manage $1 trillion care more about what people say about them and their reputation more than anyone else, because that's how they make their reputation everything. So they're the last to risk it. So they're going to be the last people to go and see, okay, because they don't get paid that much extra for making a huge killing, and they don't, because they won't invest a lot. But if they fumble the ball, they're gone. And I think that's that space, and I think, as you know, once you go public, you realize that, like, these are the most ordinary, most risk-averse people, right, that exist, right? And so I don't see those people being very kind of crypto-oriented. There's more, obviously, family offices and people, they're a little more daring, because if you're managing money for two rich people who decided that, yeah, we'll take a flyer on crypto, that's their money, their decision. The people who manage professionally other people's money only worry about lawsuits. I don't see them doing like crazy stuff. So I think that they, I mean, for the foreseeable future, there's going to be, the best money, the highest valuations, the most sustainable way is to do an IPO. And obviously it depends on the business. How well does it sell itself, right? Because at the end, people say, oh, this bank will sell it for you. Like, not really. Like, you still have to sell yourself. And so, even in an IPO. So if your company has good metrics and it would sell well when those metrics are presented, then go for the best route possible, which is still raising money traditionally, because obviously it's, order of magnitude hundreds of times bigger than whatever new crypto markets there are. But, if you don't have a choice because your business is not ready for that limelight, then, you do what you do.
Yeah, you do, exactly. I kind of wonder if there's, maybe a risk isn't the best word, but, we see companies that have higher amounts of starting capital, higher amounts of investors going for the IPO and going sort of the traditional route and maybe accessing bigger money. But on the same time, we see projects in developing countries, projects with lower amounts of seeing these crypto raise options as a really viable option for what they can do to raise capital. So is there a possibility that we kind of see these two different infrastructures building separately over time, that there's sort of a more built-out cryptocurrency raise scheme that emerges in parallel with traditional IPO and exchanges? And if so, is there sort of some tension there, or can these two things coexist?
Well, I think there's many different ways of raising capital. I mean, if you look at the private markets today, companies coming to market today are probably raising money at their FG round or whatever it's called. So there's a lot of capital outside the public markets, and which is good to a certain extent, because if these companies come to market in a more predictable way, with more predictable business models, it's good for all that transition into the public eye. But in terms of alternatives, it's good with alternatives. There has to be a broader ecosystem. I think we saw the ICOs pop up and disappear. I think the problem here was the lack of credibility and the regulation around that, and the holistic view on creating a sustainable product. Will it reappear in a different format? Most likely. Is that good? It's good if it's credible and sustainable over time. And the question is, in what format will that be? Revolutionizing the public markets is a bit more challenging, because there are so many dynamics. But there are certain pieces of the whole public market equation which can be made more efficient with crypto, with blockchain, with digitalization, and so on. And that's already happening. And hopefully we'll see that speed up over time in order to create more efficiencies. But alternatives are good. They have to be credible. If they're not credible, they will not last.
Absolutely.
Yeah, I think there's a really interesting geographic point there. So I'll pick up on the sort of the geography points. And developed versus developing markets. There's and the other thing that we've seen that's really interesting is that if you look at the largest exchanges year to date, the star market in China has really moved up the rankings, right? So this is the Shanghai Exchange equivalent of Nasdaq, for lack of a better word. So it's a market that's focused on facilitating IPO and access to the capital markets for technology companies, and tremendous growth, tremendous activity over the last few years. So look, I think as we start looking at different parts of the world, we will see challengers in terms of finding better and faster ways of raising capital. It could be on exchanges, it could be through other systems. Another aspect here as well is sustainable finance. So this must be the first panel I've sat on in a while where we haven't had that as a big theme in the conversation. But I think we'll also see sustainable finance come into play here, right? And that may be a feature that allows companies to access capital more easily. And there'll be special schemes set up to facilitate that.
Well, speaking of sustainable finance, we've talked a lot about the exchange perspective on the market right now, but let's turn it around and think about the investor perspective. What are the qualities that investors are looking for, should be looking for in companies in today's market?
Well, look, as we were chatting about earlier, I spent my formative years in private equity, so I very much come at this from sort of a long-term value creation type of story, probably unlike my colleagues in trading. So look, I'm a believer in sort of a fundamental growth story, healthy company with good market drivers that play into the big defining trends we see at the moment. Sustainability is probably one of those, urbanization, aging population, and so on. I might take a play on a sector that's been knocked down by the pandemic and is due to recover soon. Look, those are some of the features that I would look for in a good stock.
Yeah, I think obviously relevant to public markets as a whole, but I think to this sector, there are no Elon Musks in the room, right? So no one's saving the planet yet, and so you still have to worry about making money, and you still have to worry about how fast you're growing, because that's the two things people look at. And there's a great YouTube segment for if everybody follows Bill Maher on TV, where he's laughing at like Gen Z that care about the environment, that Greta Thunberg has 13 million followers on social media and the Kardashian sister has like 279 million. So while people do care about the environment, they care about their pocketbooks a lot more, and see about her closet full of shoes or whatever else she's showing on TV. And that's still the thing. As much as people want to say, oh yeah, we're virtue signaling, whatever we're doing, if you're not making money, short of you, again, being Elon Musk, you're screwed. So I think that's, outside of, because really the only two things investors care about. If you're not making money, you better be growing crazy fast, right? If you're not growing crazy fast, you better be making a lot of money. Either way, you're screwed. Like if you're not one of those. If you have both, then you're Google, right? And so, like that's the, I think that's an important element, in this thing, that there's a lot of talk about it, but really, when you're in the room one-on-one and an investor, like nobody asks that question.
Well, you may be right, but it is changing, right? And it's regulatory driven. So that is going to be the main focus for regulators over the next 5 years. It's going to be ESG, it's going to be sustainability. And there's already a number of regulations that are coming out very soon, particularly here in Europe, around disclosures and reporting based on ESG, right? So if you are an institutional investor, if you're an asset manager, you are going to have to report on ESG metrics, which means that you increasingly are going to have to invest in ESG favorable assets. So it is going to come, right? And it's largely going to be regulatory driven. For those who you're a little bit more into this kind of stuff, right? There's a number of studies and evidence and so on that prove that over time, companies that score highly on ESG factors actually perform better, right? Better decision makers, less risky, higher long-term performance and so on. So, I don't think that ESG is going away. I think it's here to stay.
Well, I think there's a difference between the US and Europe. I think Europe, the topic of ESG has been here for a long time, especially in the Nordics. I think there's a certain amount of truth to what you're saying, but at the end of the day, I think there's also the other dynamic, which many institutional investors are being forced to invest in ESG, whether they like it or not. That's the mandate that they're given. And a lot of capital will shift in that direction, whether they're good performers or bad performers. They need to invest in that transition. And if you're not, as a company, not able to tell a story in the context of ESG, you're going to miss out on a lot of capital, which is moving in that direction. So I think you as a company, you need to think through, what does this concept of ESG mean for your industry, mean for you as a company? Whether it's your customers, your governance, your business model overall, you need to understand how you fit into that context, because the world is moving in that direction, and I think it will go a lot quicker than a lot of people are expecting it. especially on the higher end. But then there will always be capital that is just looking for return of investment.
I think it's not what you're saying is false, because it's 100% true of how much money is dedicated to this stuff. And you see it in sort of tech company valuation versus energy company valuation. So many people can't invest in oil companies anymore, so the valuation of oil and natural gas, even at $85 a barrel, right, is a lot lower, you know, because of those things. So that's all true stuff. And there's, you know, whatever, trillions of dollars that make those decisions, but this is the evil room, right? Not the good room. So like, that's how the outside world looks at it, right? And this is finance, and we're not in the, you know, and it's not just finance. This is, you know, trading, right? So this is the specialty evil within evil. And that's how the regulators look at it, and that's how the public looks at it. You have to be super careful how much you push the narrative, you know, of, you know, I don't know, I do for the poor or something, because the backlash potentially, right, if somebody finds, I don't know, oh, but this is how you make your money, or this is what you do, and it's very tough. Like, the people that do it right are the people who also, that's the main focus of their business. Like I said, like the Teslas of the world, if Elon Musk goes on to sell 20 million cars a year, then the planet's, you know, 100 times better off. It really is, right? But if you all become 10 times bigger than you are, the planet's not really better off. You're better off, and maybe your customers are better off, like your business is better off, your employees are better off. So it's not a bad thing, but the planet's not saved by it, and I think, or there's not, like, you know, children in Africa don't get more water or something. And I think that that's a very important thing to think. It's very sector specific, and this sector really needs to underplay. There is enormous amount of temptation to sort of play that card, and I think you have to be very careful that you can stand behind those words for real. Right.
Yeah, look, what I can tell you is that working for one of the world's largest market data providers, the one area that comes up in every single client conversation is ESG. The growth on the ESG data sets that we provide is huge, right? So there's no doubt about that. The other thing that is also happening a lot, and absolutely with the large financial institutions, so the bulge bracket investment banks, so both on the sell side as well as on the buy side, is that ESG is becoming part of workflows, right? So it started off as something that was siloed and separated and something you did in addition or on top of your regular day-to-day work. However, now it's becoming part of core workflow. So if you're building a DCF model for potential takeover, that now includes ESG data, right? So cost of capital is going to be adjusted based on the company's ESG profile. So it seems to me, from where I'm sitting, that we are actually seeing a shift in behavior here, and ESG is becoming very fast integrated into standard working processes.
We're almost out of time, so before we go, what I'd like to ask from each of you is a prediction for the next year. We've covered a lot of different ground in terms of retail investors, different fundraising mechanisms, ESGs, so it's up to you what you want to make a prediction about, but I'll go ahead, and Cornelia, you look very eager, so you're first.
Look, so I'm not predicting any dramatic change. I think we'll have another very strong year for IPOs next year. You know, we're on a strong growth trajectory here. I think that's going to continue into next year, and then I think things will taper off in the IPO space.
Thank you.
I think the best time to party is when everyone's already drunk, right? And people are more intoxicated, like public markets, than they've ever been. So as long as that keeps going, that like Coinbase going public, that opens the door, because now you don't want to be first in anything. But like Coinbase goes public, that opens the door for all their competitors to go public as well and use that as a benchmark, right? So every time somebody pioneered something, you've got that, thing to do. So I would imagine that there should be more crypto IPOs. There should be a lot more, I think companies in this space, going public, and I think anybody who misses the window will be very sorry in the future.
Good advice for life. Thank you, Drew. And Adam.
Well, I would just say that this whole topic of, everybody wants access to the markets, continue to doing it in a credible way, diversify, create new doors, but do it in a sustainable, credible way to make it last even longer. Because there's no short-sightedness in terms of just making the most of the opportunity today. But the party will continue for a bit longer, I think, as it looks now.
Absolutely. Cornelia, Drew, Adam, thank you all so much. It's been my absolute honor and pleasure to speak with you. Ladies and gentlemen, thank you for your time and for your attention. We're going to break for lunch, and we'll continue in about 1 hour. See you soon.